So joining us to talk about that is Jim Stenning with me in the studio from Fix Securities. Jim, thanks for your time, and a couple of interesting comments from the IMF out overnight. Just on the contagion issue, what are the countries that we understand will be the most likely to be affected by that contagion, specifically out of Greece?
Well, look, yeah, I mean, it's the pigs, as they call them. Obviously, interestingly, Ben Bernanke in his address or testimony to Congress recently certainly highlighted the situation in the US over the longer term. Even with you know, the growth or recovery situation playing out in the US, there are some longer term issues about how much debt they have issued to the markets, and that the percentage of GDP over the longer term. So it really is a focus, I think, for these regulators.
Is there evidence at the moment in the markets that we are actually nervous about this issue? What are you looking at across the boards?
I mean, you only need to look at the issue in Germany, the government issue in Germany overnight, where they're expecting to issue €3 billion of debt and only accepted bids for 2.5. I mean, that's not something that indicates that the markets are working well. So there are cracks, most definitely, in the situation at the moment.
Yeah, it's just interesting because, you know, it slips off the headlines so easily at the moment, the Greek issue, but there is that issue bubbling along, and certainly bond markets are looking very closely.
There is. I mean, this won't go away, and we've spoken about that. You know, the deteriorating positions of these countries will be a death of 1,000 cuts almost over the next 6 to 12 months. What
did the IMF have to say about the Australian economy, importantly?
Well, I mean, it's all really good news. I mean, effectively, they're making comments to the effect that Australia's certainly at the forefront of the charge to recovery. I guess they're sort of reiterating comments that we saw in the minutes from the RBA that growth here will be higher than expected, and that's a very good thing. So yeah, I mean, commodity prices are buoyant, and the Australian economy should benefit from that for a number of years.
What are the implications then for the bond market specifically out of this?
Well, it's good and bad, I suppose. I mean, effectively from an issuance perspective, if growth's a lot higher than expected, then that means the government doesn't have to issue as much debt to fund the economy. I suppose on the flip side, you know, growth, higher than expected growth or rampant growth can lead to concerns about inflation. So it probably means that if they're factoring in these higher levels of growth, that forecasts for inflation in the models will increase as well. So I suppose you know, monetary policy will need to react to that.
Rising interest rates.
Rising interest rates.
Basically, and we're already experiencing that, of course. But then
we are.
It flows around the rest of the world.
That's
obviously.
right. I think this, you know, what we've seen recently, we've talked about recently, is this surprise on the upside of growth, particularly in the region. It really makes me believe that the Reserve Bank will move again as soon as possible.
When we get an IMF report out like this, they do seem to be kind of a bit behind the eight ball. All through the crisis, always revising numbers down after the fact in some ways. Do we put a lot of importance on these reports? With bond markets, I'm asking you.
Bond markets, I suppose, I mean, they haven't really reacted you know, violently to this news. I think, you know, a lot of this news is already in the market, and you're right, what we've seen particularly over the last couple of years, and it needs to take into account that that's been an extremely volatile period, is that the IMF have changed quite dramatically their forecasts on a regular basis over that period. So yeah, I mean, I think it's certainly consistent with the common theme at the moment. It's not a dramatic. It doesn't contradict what the Reserve Bank or the Fed are saying about economies. But yeah, it's subject to change, I suppose, as always.
Yeah, exactly. Can I also ask you about the Henry Tax review? What are the indications at this stage of what might be in this review?
Well, look, I mean, it's all speculation, I suppose, and I suppose there are some expectations that we might get some sort of changes in the budget from that review. One of the things that sort of is relevant to our area, fixed income, I suppose, is this ongoing debate about tax benefits for deposits, and obviously that's a very powerful thing, a very powerful thing for the providers of deposits in terms of raising liabilities. So I think, you know, if that's something that is implemented, one of the things that we feel very strongly about is that the overall or consideration of the government guarantee needs to be taken into account when considering those types of moves.
Oh, okay. And because what's the rationale behind it? Basically just getting the savings rates up and lower risk investments?
Well, it's a structural thing, I suppose. I mean, the banks would argue that the flow of funds into superannuation out of bank deposits has meant that they've had to raise liabilities offshore. Right. So this would mean that there'd be more sticky funds available domestically.
Would it actually cut investment, do you think, to super? People just leaving it in bank accounts?
Well, I mean, ultimately, I mean, superannuation is a defined contribution, so I suppose there's always money going into super. So I guess we're talking about the amount of money over and above that. It may have an impact on that, but I think that's what it's designed to do.
People don't like to hear that the banks are going to get more money and they're going to be feeling a lot better about that then. But what's the benefit to consumers? I mean, what's the...
Well, I mean, if it's a tax benefit, I mean, that's a great thing. It means that, you know, that they have that it would encourage them to save in a lower risk, in a low risk way.
And so that's what the government would really be after with this. I mean, how can they ensure that customers benefit and we don't put extra money in and then banks ramp up fees again? Well, that's right. I mean, I think there is, I suppose, from a cynical perspective, potential for those tax benefits to remain with the banks and so lower rates, but. That's why I think that competition in that space is key, and why the government guarantee has to be retained in deposit markets, because otherwise you don't have an homogenous product. It becomes a credit-related decision, and so that would most definitely fall in favour of the bigger banks. Yeah, very interesting. Jim, thank you once again. Good to see you in the studio. That's Jim Stenning, Managing Director of